Last couple of weeks, the market has been in the throes of a big correction. Despite a global market rally, India has been underperforming and in a way has been leading, the market lower. Has been a combination of issues. If we look at the first big issue, of course, is that there is not much commentary coming from the government side regarding the big slowdown, which is concerning market participants. Also, there is a bear market scare and a prolonged bear market possibilities which could last next couple of months, which is making market participants very negative and nervous, and aggressive shorting is actually happening. Not only that, if you talk of top industrialists, Rahul Bajaj, Mr. Nayak from L&T, many others have cited some government intervention and urgent need to take stock of the situation in the economy, and hence will have an impact on investor sentiment as well. Apart from that, if you look at the quality of earnings this time around, first quarter earnings are clearly reflecting the slowdown in the economy, especially the commentary coming in from top industrialists at the time of discussing their results is making everybody nervous about the outlook from here on as well. Not only that, there has been a severe demand contraction in most businesses we are analyzing on a day-to-day basis, and that is actually quite scary situation even for going forward. If you look at the credit conditions in the system, surely RBI has cut rates by 75 basis points last couple of months, but easier credit is not flowing into the economy and transmission is an issue, and that is what we are gathering from most of the lenders side, that surely rates are going lower, but transmission remains a very big issue for the economy. FIIs, we all know, last 20 sessions has been sellers in the market. About $200 billion market cap from the overall market has been wiped out since budget on the issue of tax surcharge, and the trusts which they are actually participating via into the Indian market. Some rework required there, and that is also one of the biggest reasons that FIIs have been sellers. Not only that, now there are some very few hopes which the market participants are clutching onto as the straws. There is absolutely no appetite to buy mid-cap or small-cap stocks. When the host of HNI investors we spoke to, this is the feedback actually we got. So now what happens from here on? Well, also globally, after one rate cut from the Fed, there seem to have gone into a pause and no clear trajectory whether further rate cuts will happen or not. DFIs are already struggling with defaults and outflows, etc. So now all eyes are for the market participants and big industrialists. What is the commentary of the RBI from here on? First week of August 7th is when the RBI policy meet is not only rate cut expectation, but also expectations that there could be a policy cut. Because otherwise, if you look at India, the returns for this country have become absolutely negative for this calendar year. That is a big headline to watch out for. And from here on, what kind of rate cuts can happen in the economy, how much accommodative stance and what policy changes will actually happen is something to watch out for, because NPA situation is taking the economy lower in a very sharp way. So that is the big summary as far as the market goes, and rate cut perhaps could improve the sentiment on street next week.
Thanks, Ajay, so much for that. Let's welcome in our guest now. Punita Kumar Sinha is now with us, Managing Partner, Pacific Paradigm Advisors. Punita, what do you make of this slowdown? Do you think all of the things are coming together, whether it's higher taxation for FPIs, HNI category of investors, economic slowdown, management commentary not being that great, NBFCs not being able to recover, all of the things are coming together which is taking a toll on the sentiment?
Well, let's separate out the economy and the markets. So first, let me just talk about the markets. If you look globally, most markets are up year to date. India is one of the few markets that is actually not up year to date. But the FPI flows that we are seeing in India are not isolated to India. Over the last 1 month, I was looking at the data, a lot of emerging markets have seen outflows. In fact, the majority of them have seen outflows. So some of the outflows that we are seeing in India are perhaps related to the tax fears, but some of them are just broadly in line with investors pulling out of emerging markets, equities. Now, in terms of growth, earnings growth, I'm now putting on my board, corporate board member hat, and I think from most of the companies that I'm on the boards of and the managements that I'm seeing as an investor, definitely there is a lot of negative sentiment. There's a lot of concern that there is no capital available for them to grow. And I think that's the biggest constraint India is facing, is lack of capital. So to the extent we raise taxes on FPIs and reduce that pool of capital from coming to India, that will eventually hurt the economy and the corporate sector. So I think today's discussion, or at least the news that the PMO is at least discussing the possibility of what to do with this FPI tax, is good, because I think everybody realizes, unlike China, India is a capital starved economy. And if the banks don't lend and the foreign investors go away, then where is this capital going to come from? And how is growth going to happen without any new initiatives, new capex or new investment?
Punita, stock markets aside, the larger problem is also the state of the economy. What do you think government can do in terms of a policy measure? Because, even around the budget, there was a lot of talk on whether or not there is going to be a stimulus announcement. The fact that, people were hoping and anticipating that the government would be willing to take a hit on the fisc, and maybe a major stimulus announcement will come in for the beleaguered sectors, namely autos, etc. Now all eyes are on the MPC, on whether or not it's going to be a massive rate cut. The finance minister herself, in her interview to Economic Times just a fortnight back, has also alluded to the fact that she would like to see and is hoping that the RBI would cut rates massively. In light of what the Fed has recently done, a 25 bips cut, which has come in after a long haul of over a decade, do you think the case is now only stronger for a rate cut from the RBI? And can it really materially change things on ground, Punita?
See, I think the biggest challenge is that the government doesn't have money to spend and give a stimulus, because the fiscal deficit, in fact, even at the 3.3% number, is perhaps going to overshoot, and we're going to see a much higher fiscal deficit if growth slows down. So, and if the stock markets and equity markets remain weak, then the divestment targets may not be met as well. So I think the government cannot provide a whole lot of fiscal stimulus like the way we are seeing in China, what we are seeing in other economies. So the only choice they have is to provide monetary stimulus, which they have been providing, but the challenge has been that the banks have not been passing on that liquidity to consumers, to corporates, and so and the NPA recognition norms are still quite tight. So I think they need to make sure that the banks start lending. So even if there's a rate cut, but just because there's a rate cut, I hear a lot of banks saying we may not be able to pass on the rate cut because we have to boost up our own reserves, and so somehow that rate transmission and liquidity transmission has to happen to the corporate sector for growth to pick up. If you look at earnings, I mean, the government, for instance, can't really roll back on a lot of its tax proposals, good or bad. I'm not going to debate that, but the fact is they don't have enough money. And if you look at a lot of corporates and you look at where their receivables are, whether it's the power sector, whether it's infrastructure sector, a lot of companies, most of their receivables are tied to government non-payment. And so if the government starts paying its dues on time, that will release a lot of capital for the corporate sector. And hopefully that will help them then go forward with their capex plans. So I think that's what the government can do short term, is release payments, provide monetary stimulus, perhaps rethink some of the tax initiatives to improve sentiment, and otherwise we're going to have unemployment rising. As it is, a lot of the companies are looking at costs and cutting costs, because if their top line isn't growing, then they have to find measures to keep their margins stable, or the margins will be under pressure. So I think that's what the government can do.
The point that you made about monetary stimulus, maybe a fiscal stimulus as well sometime later, but the monetary policy, or the policy meet is next week. Do you expect a bigger than expected rate cut? Because do you think a 25-50 basis point rate cut would do something, or they'll have to do a little bit more for a faster pickup?
As I said, I don't think it's just the rate cut. It has to be the transmission of the rate cut and the liquidity. So both have to be looked at. I'm not so hung up on the amount of the rate cut by itself.
Right. And what measures should be taken for a capex pickup, which you mentioned?
See, for capex, I think the main challenge is their demand is weak and capital is scarce. So I think you need to work on both sides, which is why I said that you have to lend, companies have to borrow and be able to borrow for their projects. But again, capacity utilization isn't very high right now because demand is weak, and demand is weak because there's unemployment needs to be addressed, and the consumer financing needs to be addressed as well. So I think you need to look at all of those things. And, if you look at corporate earnings right now, India, we are used to seeing corporate earnings growth of about 20-25%. But now our corporate earnings growth, very few companies are providing that kind of growth. Most of the companies are giving 7 to 10 to 15 at most. So there is a need for earnings to improve, and there needs to be demand that will drive that along with capex.
Punita, as an investor, what is it that you do? Because there are a handful of companies which you can, count on your fingertips, namely an Asian Paints, an ICICI Bank, and I don't want you to really name any stocks or companies here, but even an HDFC Bank in their quarterly performance has warned of, slowing down, withdrawing the lending. Most of the companies have only painted a negative picture. So as an investor, what is it that you do right now? Do you try and capital protect, profit take from names which have made you money, or do you try and keep that shopping list ready because there are many stocks out there which are trading at lucrative valuations?
Yeah, that's a very tough question right now. If I look at earnings growth in the US, most companies have given earnings growth of only 4 to 6%. European companies are giving single-digit earnings growth. So despite the fact that India has slowed down, the earnings growth are still higher than what we're seeing in the rest of the world. And then we have this China-US trade war that could have serious repercussions around the world. So, when you look at all the problems around the world, one would say that one should be defensive overall because global volatility will be high, valuations for the US markets are high, and earnings growth is begun to slow. So, and then China, which has done very well year to date in hope of a tariff trade resolution, is also, things are uncertain. So if India was growing the way it used to grow, one would say one should continue to be focused and overweight India. In fact, most emerging market investors, if I looked at the data, last data that I saw, they were still one of the only markets in emerging markets that they are still overweight. So they haven't reduced their overweighting and gone to zero. So I think clearly people still find pockets of growth in India, and given that it's one of the only markets that is down this year and has underperformed, a lot of the negatives are probably discounted. So I would say that there is value in India. One will have to be patient, and one will have to combine value with quality and be very selective. But overall, from the global market perspective, one has to be a bit more defensive. But in India, there is potentially more value than there is in other markets.